Happy Friday, everybody. As you know, Don Garman here from Mirador Capital Partners. We considered giving everybody the day off, but of course I wanted to come back because of my unbroken string of coming in on green days. Obviously, green means things are up, not down. And I thought I would address one topic that I got yesterday, and it would sort of be just a quick hit on a Friday, and then of course we'll check in with you next Tuesday. I think Lauren and I will check in with you next Tuesday. So obviously the tone as the curve has flattened has shifted, right? So a month ago we were down 5% a day, and then we went down 5% 3 days in a row and up 5% the fourth day, and then it became a smaller magnitude anyhow. So we've now obviously gotten to the market is trying to sort out kind of what's going on. So the question that I wanted to address today is I got from a client yesterday, which is the news seems to be better on the virus front. Great news for from every perspective. Would this be now a time to be more aggressive and to shift the strategies back to a more aggressive posture? And I want to answer quite directly why I don't think that is the case and why that's not how we're seeing this playing out. So what I've asked Daniel to do is include a table that I'm going to be referencing. And you guys, if you've ever talked to me for more than 5 minutes, you've heard this already. And it's the table of the earnings of the S&P 500 and the realities of what that what it represents, and why we're not in the camp that this is all in the past and now we can go back to kind of looking at the world the way we did a couple months ago and invest in that same style. So what I've asked Daniel to do is go back all the way to 2006, right? So that was the year, the financial crisis really is sort of thought to be 2008 into 2009, and the market bottomed that first quarter of 2009. But there were cracks in everything starting in 2007. And I know that because I was with some friends in the middle of the summer of 2007, this, the big plugged in hedge fund types, and they were really, really concerned even long before it was even something that was sort of catching the public's attention in the middle of 07. And people were still kind of, wheeler dealer real estate moguls in the middle of that year, but not by the middle of 2008. So when we look forward, all I'm going to ask you to track through is the number of earnings that the S&P 500 companies produced and the multiple of those earnings, and we're also going to include the growth rate and the year-on-year growth rate at the bottom. And so there's also a ratio called the PEG ratio, which is the price earnings ratio to the growth rate. So I know that's sort of a lot, but my point is you can see in 2006 to 7, in 7, earnings did not really grow versus 6. And then in 2008, the earnings were down 17%, 2009 down 16%. But it was in the third quarter of that year when the year-over-year growth rate turned from this way to this way. So now, if you're looking at this table, take a moment and just go to 2020. We've been harping on this, I think Lauren and I, for a long time, and now Jonathan as well has been talking about the same thing, which is, up until actually a few weeks ago, earnings for this year were expected to be flat or even up a little bit versus last year. Well, we all know that was not going to happen with the, shelter in place, and, we were all in. I mean, who spent any money? Where can you spend any money? Nowhere. So now we can see that to this moment, earnings for this year are expected to be down 12.1 versus where they were last year. So the truth of the matter is, to this point in time, stocks are more expensive now than they were at the beginning of the year after a pretty great year last year. So that's if you think 12 is the low. is, in other words, this is it. All of the downward revisions are already in, and we're good. I don't think that's anywhere even close to even fathomable. So I feel like 2020 will be the year. And Jonathan had highlighted we were concerned about earnings per share last year, which were supported by buybacks and the greatest economy the world's ever known, according to some. And so there were some cracks in the dike in terms of real earnings all of last year, and we kind of got through it. And then this year off to a reasonable start, and then we get a global pandemic. So my point there is it conceivable that earnings have quite a ways to go down? And if you're a CEO running a company in 2020 and you had anything that you were concerned about lingering on the income statement, or this is the year to push it all through, because a lot of CEOs are going to get kind of a pass on their business performance in light of all of this uncertainty. So all of these factors lead us to maintain what we would call a balanced posture. And when you've heard me talk about it in terms of amplitude, we're fine having a narrower amplitude if we're going to be, if we're in the second inning of what could be a 9-inning or extra inning mega ball game. And so of course the risk to that is that was it. Global pandemic is over, and we're all going to be right back. They're going to open everything May 1st, and May 2nd, everybody's going to be, restaurants downtown, and, in bars and in gyms and everywhere else. I don't see that happening. And so I don't, and whether I see it happening or not is completely irrelevant. I don't think it's smart to invest your money as if that's what's going to happen. And that would, in essence, be let's widen the amplitude now. Let's take the defense off the field. Let's go to a horizontal offense playbook. So that isn't how it's not prudent to bet that way. And so that's not how we're going to be betting. But it is nice that we've gotten, a little bit of green here over the last few weeks. And so it's, I think it's given everybody a chance to, take a deep breath, and the weather's getting a little bit nicer. And so it feels a little bit better for some reason. And obviously flattening the curve makes everybody a little less tense, I think, and hopefully we can not get ahead of ourselves and continue to err on the side of caution, I think is what we're calling it. So as I said, we were going to give you all the day off, but we have gotten some incredibly nice feedback from a pretty large group of you that seem to appreciate that we have been proactive in our attempts to communicate, and so much so that you've been telling your friends about us, which is amazing. And I said it to somebody yesterday, it's like the highest compliment that we can ever receive when you think enough about, we can't tell, what's going to happen in the markets tomorrow. No one can. But the fact that you've appreciated our attempt to be out in front of you with sort of, frank talk about what we can control and what we can't control. And I can't get through any of these without thanking my team at Mirador and our clients for the incredible support that you provide to us, financially, and in addition to spiritually and morally and every other way you can. And so the team here has been awesome. My hat's off to them. Second quarantine haircut given by my wife last night. It's a skill I did not know she had, but I'm pretty pleased. And the beard, everybody still hates the beard, including me, but we're going to see this through to the bitter end, which is the shelter-in-place ending. And on that note, 11:10, snug 8 minutes. Have a great weekend. Enjoy some family time, which is kind of what we get to do. And I'll look forward to chatting with you all soon. Thanks.